Good afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your October market perspectives. Johnny, the big question is, what are the kids going to be for Halloween?
We've got a baseball player and a inflatable chicken. So
Love it. I love it.
Mixing it up.
Our 16-year-old, she was Justin Bieber on Saturday night. So
I love it.
Lots going on in the market. Our conversation in August and in September, you mentioned, when I always ask you to sort of kind of give us a little bit of prediction, you talked about volatility. And here we are. Market's been down. We're up 300 points at the moment on the S&P today.
Or in the Dow.
The Dow. I mean, we're volatility is here.
Yeah.
Is this one of those moments where it's like, October fright, November might? I mean, is it one of those deals? What are you thinking?
It's darkest before dawn, right? And it feels pretty dark. I mean, we've talked about, as you mentioned, volatility a month ago, and add even more into the equation. We have a horrible conflict in the Middle East, and with Israel and Hamas, and we've also seen a softening in earnings. I mean, the expectations were really low, but as recent as September 30th, the year-over-year expectation for Q4 earnings, which is on the horizon, has come down. So we've continued, I think, as interest rates have really taken hold from what the Fed's done in the rate hiking cycle. It's kind of kicking the can, further down the road in terms of having more of a fundamental impact. That said, we've seen just a really large degree of negative headwinds. I mean, the outside of the geopolitical conflict, we've seen the UAW strikes. We've seen the Speaker of the House situation. I mean, there's just been a number of things that have created.
It's not what's considered a calm time right now. I mean, there's a lot of different cross currents in terms of, and really, negative headlines.
It's reflected in price. I mean, if we look at the last 12 months in the market, there's only two sectors that are positive. It's communication services and tech.
Yeah.
That's it. Everything else is negative. We were just talking before this, small caps are down about 33% from their highs.
Yeah, that's ugly.
You've got the median stock in the S&P down 4% year to date, and the index itself is up 8 or 9. So there's been a lot of damage, I would argue, that's reflected in price. And we're this year's been interesting in that seasonal scripts you can only really take with a grain of salt, but it's followed pretty closely this year. And a soft August, September, October, and we're hitting that tail end November, December. So we'll see. There's a lot of noise, certainly more earnings to come out, but we like the prospects of a market rebound here. We've seen a lot of negativity expressed and a lot of sentiment gauges, which is a good contrarian indicator.
I think it's interesting when people talk about the soft landing that the Fed's trying to land, but small companies are down 33%. I mean, that's not a soft landing.
No, it's not at all. And those are all, credit rate sensitive type of, exposures. You've got a meaningful portion in small cap that are non-profitable, which are having an impact too.
Yeah. Longer term though, in the way you and I think, is that seems like a really great opportunity as you look out the future.
That's the way that we look at it. We think investors should look at it that way. I mean, we don't know that today or tomorrow or next week or next month for that matter is the ultimate bottom. But, when you look at valuation levels, at small caps are trading at, 11 or 12 times forward earnings, mid caps similar. So in terms of a core allocation, there's a case to be made for that. We're going into the seasonally best 6 months of the year. If you look back historically, which tends to matter more than not.
The November might is what we're looking for, right?
That's right.
The other thing though is that you look at something like the smaller mid-cap space and you feel like, okay, there's deep value there. Let's go after it. The challenging part of managing a portfolio and really how hard do you allocate to those portions of your portfolio, right? Especially now you look at, to get a car loan, it's 6%. To get a mortgage, it's 8%.
Right.
Not a lot, hardly any of our clients have credit card debt, but credit card interest rates are at 20%.
Yeah,
I mean, these
all-time
things
highs.
are these things are really going to have an impact on spending, consumer spending over the course of the next 12, 18, 24 months.
You bet. And I think that's what surprised so far. The consumer, generally speaking, both from an overall net worth perspective and from a debt ratio perspective, was really, really strong.
Yeah, held
entering
up.
this period.
Held up.
And add to that on the economy side of things. I mean, we got an annual GDP print of 4.9%. There's been a massive fiscal thrust that's taken place. We've got the Inflation Reduction Act, infrastructure bill, the CHIPS Act. I mean, all of the spending. That's part of the concern on the inflationary front. We've got significant spending.
Well, they've spent so much, it's almost impossible to determine when sort of the balloon is going to deflate.
Right.
In terms of the spending of the consumer.
Right. When we look, though, at inflation, which is really one of the key focuses for the market, the rate environment has been a significant headwind and overhang for equities. With the 10-year at 5% thereabout, we'll find out this week when Chair Powell speaks and has the announcement for Fed funds on Wednesday. We expect a pause, but they very well may be done. And if we get any reprieve in yields in the U.S. dollar, that's a nice recipe for risk assets to advance once again.
Absolutely. Okay, so your team, what is your team seeing right now? What are you guys looking for over the next 3 to 6 months?
Yeah, we've said all along, really throughout the course of this year, an expectation for recession is in the cards, but typically that's you see a risk on advance prior to, and just nobody knows the timing, of course, of these things. But with a 4.9% GDP print annualized here recently, it's probably a mid-year 2024 phenomenon. And, prudent position sizing in regard to portfolio construction, paying attention to cash flows and valuations.
Yeah.
We've talked about lengthening duration, which we've done on a number of occasions. We still have a potential for another one to do. We've been patient in that regard. We look at, the interest rate backdrop and particularly the longer portion of rates, 10-year plus, and we look at legging into that, dollar cost averaging into bonds, similar as one should look into dollar cost averaging into equities because there's real appreciation becomes attractive.
There's real appreciation at the longer end, right?
Right, that's right.
You have to be a little bit courageous though to do it at this time, right?
Yeah, we're process oriented with it. It's of course not based on feel, but we have the process that we're following and we're continuing to leg in there, and we're not worried about, again, next week or next month, but we have great conviction that if and when a recession sets in some point in 2024, that the rate backdrop is lower, and that's a benefit for fixed income investing. And
well, I would also, over the last couple of years, set it and forget it hasn't worked.
Right. That's right.
Over the course of a 10 to 20 year period, that probably is okay. But when you get into periods such as this, where we're 2 years in now, where hardly any returns have been begotten, like you got to work hard to get those returns, and that all comes back to the fundamental process that you're working on.
Yeah, you're right. We've talked about the different sectors and technology. We're the kind of the last sector to fall. We see Apple earnings here later this week, which will be interesting, but we've seen softness finally out of tech. Amazon had really good numbers, but a lot of the other big cap tech names have kind of been the last to come down.
Right.
And
will they hold up and keep this market up? Or if they go, where does this market go?
We'll see how that transpires. But you can also identify interesting valuations and defensive characteristics out of other sectors that are much more levered to the rate construct that have been really beaten up. You've got real estate, you've got utilities, you've got healthcare. I mean, all of those are down double digit or more, and have some level of valuation support. Again, defensive in a recessionary type environment. Again, we don't know the timing, but we do believe it's a 2024 phenomenon.
And that's where the process and the ability to be tactical
that's right. Yeah.
really helps you in terms of your portfolio management. Anything else on the economy? Anything else on the markets? Or
No, I
stay
just think,
disciplined?
I think, keeping a disciplined process, mindfulness around valuations and cash flow, and really position sizing in the different segments of the portfolio. We've talked about the less correlated to non-correlated space, alternatives, whether that's daily liquid solutions, whether that's less liquid solutions, continue to have their place and have worked well.
Great. So wonderful. Well, John, thank you for your time today. We really
you.
appreciate it. Thank you all for the opportunities to be stewards of your wealth. As always, if you have any questions or need anything in terms of your portfolio construction, please contact your wealth advisors here at Trilogy. For John MacArthur, I'm Kent Scornia. We hope you have a wonderful day and happy Halloween.